Welcome to the latest episode of Damien's Market Update, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, I make this show every month, so make sure you hit that like button if you're watching it on YouTube and subscribe to the channel. And it's for people who may be running their own investments, but also those people who are DIY investors that buy and hold. So you might be a passive investor, but you just want to know what's really driving your portfolio. And in particular, this month, you'll probably be wondering why equity markets are on a bit of a downturn. I'm going to explain that in a moment. Now, in last month's market update, I discussed the possibility of a Santa rally in December. Now, there are different variations and definitions of what a Santa rally is, but I tend to use the definition of a positive December. Now, that didn't actually materialize in the UK or the US, and that's despite it being a US election year, which is normally very positive for the likelihood of a Santa rally. Now, equity markets started 2025 on a positive note, but as January has worn on, we've seen equity markets start to struggle. And one of the unfolding trends you really want to watch in 2025 is actually the rise in bond yields. So we've seen government bond yields climbing globally, and that's because investors now believe central banks will keep interest rates higher for longer to combat inflation. They're also demanding a high rate of return for lending money long-term to governments because of the projected scale of government borrowing, which theoretically raises the risk of default. Now, if you go back to the December low in the 10-year US Treasury yield, it was about 4.15%. And that was actually achieved on the day that the US Federal Reserve actually had its last meeting and it cut interest rates by 0.25%. Since then, the 10-year US Treasury yield has surged as investors have re-evaluated their view on the Fed's ability to cut rates in 2025. Or in other words, after the last rate cut, investors have become less convinced there will be any more to follow in 2025. Now, this rise in bond yields could eventually have a significant impact on equity markets, even sparking a crash. And it's due to something known as equity risk premium, so ERP for short. If you imagine you have two investment options, so you've got a safe government bond and a potentially riskier investment in the stock market, so we'll say the S&P 500, the ERP is the extra return you can expect to earn from the stock market to compensate for the risk that you're taking, that extra risk. And it's calculated as a difference between the S&P 500's earning yield, so the profitability of the stock market, and the 10-year US Treasury yield, so the return on a safe government bond. Historically, that number has been positive, meaning stocks are expected to outperform bonds over the long run. Now, currently, the gap, so the ERP, is narrowing and it's nearing zero and it's potentially going to turn negative. Now, this means investors are essentially getting little to no extra reward for taking on the high risk of investing in stocks. And this unusual situation is driven by that recent rise in bond yields as bond investors demand a bigger reward for lending money, and the high stock valuations that we've seen, which have been fueled by the excitement around tech and AI. If this trend continues, it could signal that stocks are overvalued and due a correction in the near term, with investors shifting out of equities into bonds. Now, analysts at Goldman Sachs and JP Morgan believe that when the 10-year US Treasury yield hits 5%, bonds become increasingly attractive versus US stocks, and the likelihood of a US stock market correction grows. While other investment bank notes tend to agree, some actually believe we won't enter the unhealthy territory until we see the 10-year US Treasury yield hit 5.2%. So at the moment, we're about 4.75% on the 10-year US Treasury yield. So we've got a little way to go, but the warning signs are there. The point is, it's no longer just Trump's trade war threats, politics, economic data, or central bank policy that's concerning equity investors. Bond yields are now starting to demand more of their attention. And if the bond part of your portfolio keeps falling, it could soon start to hurt the equity part too. Now, if we do see some more equity market volatility, here are some key levels to watch on the major stock market indices out there. And this is based on insights from my latest technical analysis article that I published for 80/20 investor members. So if you take the FTSE 100, right now, it's in a sideways consolidation range between 8,012 and 8,360. And it means that if we see the FTSE 100 gain enough momentum and break above this zone, then we could see another all-time high. Conversely, if we break below 8,012, it could lead to further downside and ultimately see the index head back to the previous sideways trading range of 7,257 and 7,730. Jumping over to the S&P 500, well, we've had a strong uptrend, and the S&P 500 has since found resistance at 6,000 and experienced a bit of a pullback. It has now formed a support level around about 5,870. A break above 6,000 could see the index retest its all-time highs, but if we go below that 5,870 level, then we could see further declines. Now, if we're looking at the Japanese stock market, the Nikkei 225 has been consolidating between 38,000 and 40,000. Now, a successful break above 40,000 could signal further gains, with the next target potentially being 41,500, and it has tried to test that 40,000 level a number of times. On the other hand, a decline below 38,000 might suggest further downside, with some support potentially around 37,000. Now, before I finish this show, I will just mention the old investment adage, as goes January, so goes the year. Now, there are different interpretations of the adage, but one, referred to as a January barometer, states that if the stock market performs positively for the whole of January, it is likely to indicate positive returns for the stock market for the remainder of the year. In fact, since 1950, the January barometer has now only been wrong 12 times. So that boasts an accuracy rate of 83.8% on the S&P 500, as reported by the Stock Traders Almanac. So if we get a positive January this year, there's a very good chance it could be a positive omen for the full year of 2025. So it's something to bear in mind ahead of the next show that I do in February. So that's it for the show this month. As ever, if you've enjoyed it, do hit that like button, but also subscribe to the channel. If you're listening to this as a podcast, then make sure you do follow or subscribe on Spotify or whatever app that you use to listen to your podcasts.